Standard deduction. The standard deduction is a fixed amount of money the government allows you to subtract from your income before calculating taxes. It was created to simplify the filing process so people would not have to track every small expense. The amount changes based on your filing status and is adjusted over time for inflation. Most taxpayers choose this option because it is simple and often large enough to reduce taxable income without extra paperwork. It matters because it lowers the income the IRS can tax, which directly reduces how much you owe. Itemized deductions. Itemized deductions allow you to list specific qualifying expenses instead of taking the standard deduction. This method became more detailed as the tax code expanded to encourage certain behaviors, like homeownership and charitable giving. Common examples include mortgage interest, state and local taxes up to a limit, and large medical expenses. You would choose this route only if your total eligible expenses exceed the standard deduction. It requires more documentation, but it can significantly reduce taxable income for people with high qualifying costs. Above-the-line deductions. Above-the-line deductions are subtracted from your gross income before your adjusted gross income, or AGI, is calculated. They are available whether or not you itemize, which makes them especially valuable. Examples include student loan interest and contributions to certain retirement accounts. These deductions matter because they lower your AGI, which can also help you qualify for other tax benefits tied to income limits. Business expense deductions. Business expense deductions apply to self-employed individuals and business owners who spend money to operate their trade. The tax system has long allowed these deductions to ensure people are taxed on profit, not total revenue. Qualifying expenses include office supplies, equipment, advertising, and even a portion of home costs if you work from home. The key requirement is that the expense must be ordinary and necessary for the business. These deductions can dramatically reduce taxable income for entrepreneurs. Home mortgage interest deduction. Home mortgage interest deduction allows homeowners to deduct interest paid on qualifying home loans. It was introduced to promote homeownership and stimulate the housing market. Only the interest portion of your mortgage payment qualifies, not the principal. There are limits on the amount of debt eligible for this deduction. For many homeowners, especially in the early years of a mortgage when interest payments are higher, this deduction can meaningfully reduce taxable income. Charitable contribution deduction lets taxpayers subtract donations made to qualified nonprofit organizations. This provision supports philanthropy by offering a financial incentive to give. Donations can be cash or property, but they must go to approved organizations. There are percentage limits based on your income. Keeping receipts and proper records is essential. This deduction not only lowers taxable income, but also reinforces the connection between public policy and private generosity. Medical expense deduction. Medical expense deduction allows taxpayers to deduct certain healthcare costs that exceed a set percentage of their adjusted gross income. The idea behind it is to provide relief when medical bills become unusually high. Qualifying expenses can include surgeries, prescriptions, and some long-term care costs. Routine or cosmetic procedures usually do not qualify. Because the threshold is relatively high, this deduction primarily benefits people facing significant medical expenses in a given year. State and local tax deduction. State and local tax deduction permits taxpayers to deduct certain taxes paid to state and local governments. This includes income taxes or sales taxes, as well as property taxes, up to a capped amount. The deduction has existed in various forms for more than a century, reflecting the balance between federal and state taxation. Recent law changes placed limits on how much can be deducted. For taxpayers in high-tax states, this cap can make a noticeable difference in their final tax bill. Retirement contribution deduction. Retirement contribution deduction applies to contributions made to certain retirement accounts like traditional IRAs or self-employed retirement plans. The government uses this deduction to encourage long-term savings. Contributions reduce taxable income in the year they are made, though withdrawals in retirement are generally taxed. Eligibility can depend on income and whether you have access to an employer-sponsored plan. Over time, this deduction not only lowers current taxes, but also helps build financial security. Student loan interest deduction. Student loan interest deduction allows borrowers to deduct a portion of the interest paid on qualifying education loans. It was introduced as college costs rose and student debt became more common. This deduction is taken above the line, so you do not need to itemize. There are income limits that phase it out for higher earners. While the amount may seem modest, it offers meaningful relief during the early years of repayment when interest payments are at their highest.